Dipan Mehta joins us. Dipan, it's looking not great, but it is looking better than when we spoke last time. Has the storm come and gone?
Yeah, good morning, Nikunjan. Thank you for having me on your show. The thing about markets is you come to know about storms, whether they have come and gone, and bottoms have they been created or tops they've been created only after a few weeks. But I would say that this budget clearly is a step in the right direction in terms of reversing the slowdown which we have been seeing in the last 2, 3 quarters or so. How much of an impact it will have, I think only time will tell. Also, I think largely the large cap stocks are reaching that reasonable valuation phase. There's still a lot of overvaluation in some of the mid-cap pockets, but I think that also will get corrected over time. So we are not at the sweet spot as yet where valuations are mouth-watering and it's absolute no-brainer to go and buy stocks, but we seem to be getting over there.
When we spoke to you last, you were quite bearish actually. Your view was that raise cash, sell, don't buy. Has your view changed, or it is still on the bearish side?
Well, Nikunj, I'm still very cautious and I don't want to part with money that easily. And if there are opportunities to raise cash levels, especially companies where we are seeing high valuation and slowdown in earnings, that opportunity also we are still persisting. It's just that we're watching the market. This budget was, I think, very good in our opinion. We did not expect, I think nobody in the market expected a 12 lakh rupee up to 12 lakh rupee income exemption. That's going to throw up a few opportunities. We are trying to evaluate what opportunities do get thrown up. At the same time, I think we've seen a very deep correction in a lot of the capital goods companies, where I think that there is still scope for these earnings to improve over there, but valuations certainly have corrected a little bit over there. So from a situation where it was highly overpriced, extremely expensive, I think we are getting to a lot of normal type of valuations for many businesses, but markets tend to go in extremes. And certainly we are not in an extreme situation where valuations are really attractive. We are at that fair value zone, in my opinion.
Okay, on that positive note, let's analyze. Okay, on that positive note, let's analyze two stocks and most intriguing moves there. Trent, which had the biggest crash yesterday, one of the steepest intraday falls. I mean, not to say that Trent has not been falling quite consistently over the last 1 month or so, but again, after climbing close to that 6,200 mark, it again got slammed all the way back to that 57.50 level in trade. It's lost about almost 18% in just the last 1 month alone. The one stock that was holding up yesterday was Reliance, and there is a near-term trigger perhaps. Shein, which was, remember, a banned Chinese retail apparel app in India, has made a comeback, and now the India relaunch, which is with Reliance Retail, the app has launched on February 1st. So the big fear for Trent is whether that's going to eat into Zudio's business or not. Let's analyze this piece. We've got Karan Tarani joining in on the show right now from Elara Securities to tell us about. Karan, hi, morning. How big a threat could Shein with Reliance Retail turn out to be for Zudio?
Hi, Aisha. Good morning. So I think Shein coming in the market obviously is going to be a disruptive force because if you look at the pricing of Shein, it is largely on par with Zudio. That's the first thing. And secondly, they kind of bring a lot of global expertise in terms of styling, fashion, where, Zudio has an edge ahead of the peers that they have. But I think it's a long haul because Shein is coming to the online market. And the online market is quite fragmented. And if you look at Zudio, they are only in the offline market. So both these markets are very different in terms of the way they function. Online market is crowded by multiple platforms with the likes of Myntra, Amazon, Flipkart, Meesho, and Ajio, so on and so forth. And if you look at Zudio, I think they are primarily the offline play. They don't enter the online play as of now. And I think as per our assessment, they don't have any plans to enter online as of now. So I think both these are very different propositions. There might be some negative impact, but not a very big one because the models are separate, the monetization models are separate, the online offline models are separate for both of them.
Do you think Trent is falling because it was expensive and this fall was overdue? There is no point in blaming it on this app, that app. It was expensive and it is falling. As simple as that. Story over.
Yeah, I think Trent does have concerns in terms of growth. So there are two concerns here. One is in terms of increased competitive intensity. We are seeing a lot of new players coming in the fast fashion segment, Companies like ABFRL, companies like Shopper Stop have got their own fast fashion brands right now. If you look at the older companies, the value retail players, Vishal, Megamart, V-Mart, Style Bazaar, it's quite a crowded market. Max Fashion, there are about 8 to 10 players playing the fast fashion segment. Clearly, the reason for that is that this is the segment which is most attractive in terms of growth. It's growing at about 25-30% plus. So there are concerns as far as Trent growth rates is concerned. So the first thing in terms of increased competitive intensity that could add pressure on Trent's growth rates. But the second concern is around store addition. So I think Trent right now stands at a very reasonable number in terms of number of stores at about 600. We do see store addition going ahead. We do see about 1,000 stores coming in the next 3 years. But beyond that, how things scale up is a challenge. Plus, they have also done consolidation in the recent past when management has indicated that they've shut down stores wherein there is fortressing of market, there's an oversupply situation, throughput of the new store is not being good. So there are concerns around that. There are concerns around growth because of competition. There are concerns around store addition as well.
Would you buy Trent at these levels? I mean, optically, some would look at the screen and say, "Arey baap re, kitna gir gaya, 750 ko 5000 ho gaya," right? That's the first impression everyone has when you see a stock fall like this.
So I think we would recommend we have a buy rating on Trent. Primarily the reason being that the stock has obviously come off in terms of valuations. We cannot expect the stock to grow at 50-60% CAGR as compared to what it was historically. And we cannot even expect the valuations to hold on at those kind of levels. But at these levels, I think the valuations appear quite reasonable. Risk reward is quite favorable as well. We don't see much of a downside for Trent from here on, primarily because Trent is a fast fashion based player. If you look at the other players in terms of value retail part, they primarily focus on pricing. And if you look at Trent, they focus on pricing and on fashion. So we believe that despite increased competitive intensity, Trent will continue to have its edge. And that's the reason we are kind of positive on Trent. Second big reason is the market, right? So the fast fashion market is growing at about 30-35%. So there's ample opportunity to penetrate, to deep dive further. And third is, of course, the product assortment, the Gen Z cohort, which Trent has, kind of got it right. If you look at the other value retail players, the other fast fashion players, they are kind of confused. Some are going for the family, some are going for women. So I think Trent does have a moat. And right now, we don't expect the 30-40% upside to come in the near term, maybe 6 months, 8 months. But from a 2-year horizon, definitely, one can look at Trent.
Okay, Karan, thank you so much for that analysis and good to have you on the show as always. And I saw Dipan Mehta, smiling when we were talking about Reliance versus Trent. Dipan, which side of the camp are you on?
No, we are not going to take sides over here. I think both are great companies. But I don't think that that's the reason for Trent correcting. I think what Nikunj said, that it's expensive and we definitely will see a slowdown in earnings. It's just not sustainable. Base effect will come into play. And in markets like this, certainly they're going to be, the high P stocks are going to be targeted for correction. A lot of players who have got into such momentum stocks look to exit. So we are seeing a correction. Reliance, I think it's getting clearer by the day that it's going to become more like a holding company. And we don't prefer to buy holding companies. I think when Jio's IPO comes or retail IPO comes, that would be very exciting times for minority shareholders. And that would be good opportunities for long-term investing. But at these levels in Reliance, I don't see any great trigger. Whenever the IPO comes, some value unlocking will be there. But we will see migration of shareholders from the holding company to the new listed entities.
Dipan, this whole talk that Capex is over, consumption is the way forward, build India is over, buy India is the new theme. Would you concur with that?
No, not really, Nikunj. See, I think what has kind of rattled the market is that the actual capital outlay for the government is not as exciting. But it's not the money which is at play over here, it's the actual execution. And even in this financial year, we have not been able to meet the capital expenditure targets of the government. So from that point of view, I think more reasonable amounts have been kept. And if the kind of execution improves, I think capital goods manufacturing companies will still do quite well. And I think the correction which we have seen, as I said earlier, is an interesting opportunity. And a lot of capital goods companies may be reaching that fair value. One thing we need to note is that a lot of them are sitting on very good order book position. And also a lot of them are looking at international order inflows across the board. So that I think is we're reaching a nice sweet spot, hopefully sooner over there, especially given the earnings visibility. And by the way, Nikunj, if liquidity improves in the system, interest rates are reduced, then even more capital expenditure will take place, and the government will certainly try and step up on its side.
So, Dipan, anything that's looking interesting within the Capex theme, which may have corrected a fair lot?
I think, see, according to our first usual disclosure, we and our clients are invested. I think Larsen and Toubro came with a very good set of numbers and very strong order book position also. And it is so well diversified order book position, projects within India, outside India as well. And that's one stock which is continues to show kind of compounding of earnings. And if you strip out all the kind of subsidiary companies which will never be unlocked, still the valuations are reasonable. I think Afcons is also interesting to as a company to look at, and so on and so forth. I was very impressed with KEC International also. Numbers were pretty impressive, very strong order book position. And stocks like ABB Siemens, which was super expensive, they've seen a huge correction over there. And I think that considering that they will always be expensive in terms of price to earnings multiple, at least that there is that scope that they would have bottomed out. And as earnings grow, these companies also will start showing stock returns in line with earnings.
Start gravitating towards large cap stocks then. HDFC Bank, Reliance, L&T. Suddenly these stocks, which in a sense are the horsemen of the market, are showing signs that they're ready to really, rally. Which is the strongest large cap stock in your book?
HDFC Bank out of the three is definitely.
Abki bar those are?
Let's hope this time the stock does give a positive push. Reliance, I think, has been a stock which has been waiting, or that breakout is impending for the stock for quite some time. We're discussing this when the stock was almost at 1200 levels, and the risk reward starts to look very attractive, but the stock never fired up in terms of momentum. And I think for the first time we've seen the stock yesterday showing some signs of strong market alignment as well as strong bout of momentum. L&T was a big surprise because the stock in the last 2 days had fallen very sharply on the back of some disappointment in terms of the budget expectations, etc. But then I think the comeback yesterday just whiffed off some bit of short covering which was there into the stock on the data. So that indicates that maybe we could be looking at another bout of short covering move for L&T over the near term. But all three of the charts are completely different in terms of the context. HDFC Bank, for example, is one of the stronger names. The stock has been more formidable, more resilient in this last 1 week, 1 month of up move for the for the stock. Reliance has been an underperformer, but that stock has made a comeback, and L&T I think is a classic short covering candidate.
Sometimes when you say the excesses in the market, and I was just looking at data on Saturday, and I said, okay, consumption stocks have gone up, fair enough, tax cut has come, but diagnostic stocks went up. Now with the extra tax money, you will not get blood tests done, man.
No, but you will look after your health better.
I know, but just think about
it. If you look after your health better, that's your first port of call.
Just think about it.
I'm telling you, watch the Brian Johnson podcast.
My mic's falling, so I'll just put it back again. But just imagine how markets can correlate. Anything and everything. Dipan Mehta, ठीक है, consumption will do better, but diagnostic stocks going up after the budget. That's a bit too much, right?
Yeah, maybe you're right, Nikuj. But see, I think diagnostic stocks last 2 quarters, the earnings have improved. Of course, base effect is benefiting them. And these are stocks, where the long-term growth trajectory also is very decent. And valuations also have come up from what they were 2-3 years ago or so. And investors looking for safe stories to play on. Now, FMCG is no longer a safe story from that point of view. So, from consumption and from safety point of view, I think diagnostic stocks certainly fit that criteria.
The other stock which, in a sense, which gave a big move actually yesterday was Jio. And 6% of Reliance is held in Jio because that's how the structure is. And if Reliance does well, the sum of part valuation for Jio will do well. And Jio has gone down. I think 330 has become 245. Nuresh, is there a trade in good old Jio Financial Services?
So it looks like a bounce back area. If you look at the stock topped out at around 390, back to 230 odd levels. Post the listing, the stock had made a bottom around this 200 mark, roughly 180 to 200 mark, and used to trade between 200 to 240 levels for almost 3-4 months. So this is the starting point where the rally started from, and from 230 it went to 390. So out here, one could actually keep a stop loss below 235 and look out for a bounce towards 280 in the short term.
Dipan, we'll cut to a view from the Nestle management, but what is your view on staples? I'm purely talking about staples. There is a school of thought which says, okay, these are good companies, but still expensive. There's one school of thought which says that, look, they've corrected for 2 or 3 years. They will never become cheap. They will never come to P multiple of 20, 30. So if you're waiting for these stocks to come to your desired P multiple, then you can wait forever.
Nikunj, from an investor's perspective, unless you're convinced that the top line can grow at 15% compound for next 3 to 5 years, you should not be looking at that stock at all. And from that point of view, I think long-term growth rates of the entire FMCG industry have come to sub double digit. The larger ones, it is more like 3 to 4% or so. The smaller ones, 7, 8% or so. And those kind of top line growth rates will not really get you into any great outperformance or superior returns. But these companies are great in terms of protecting your capital. And I agree that the valuations for these companies is certainly not, P multiples is certainly not go down much further from these levels because there's a lot of shareholder loyalty, low floating stock as well. And some investors do prefer the kind of dividends which they get and bonus and from time to time. But there's no growth. These are static companies. They are stagnant companies. And when you come to the equity market, you are looking for growth companies. You want to compound your portfolio returns by at least 15, 16%. And I don't think these companies can provide you that kind of returns over the longer term, like 3 to 5 years or so.
Fair point. Dipan, what about the other leg of consumption and hospitality? Where within that do you find comfort to maybe add on to positions within the hotel space in particular?
I think hotels certainly, and Indigo is looking quite interesting as well. I know optically the numbers were disappointing, but that's because of a huge forex loss, and management is working on that risk factor as well. If rupee stabilizes, I think you will see very good bottom line numbers coming through from Indigo, and their strategies in terms of expansion globally, and also in terms of moving up the value chain by offering premium position, that also has been pretty well received. And there's a lot of pricing power certainly has come back to the entire airline industry, and the consolidation is helping Indigo as well. So within the consumption space, I think travel, tourism, hospitality are kind of the new FMCG, so to speak, new FMCG sectors that one could look at. And as a measure of disclosure, we are shareholders of Interglobe Aviation, so our views could be biased to that extent.
Okay, Interglobe Aviation, that's the top call. In the last 52 weeks, of course, the stock has seen a good return of about 39.5%. In the last, I think, 1 month or so, though, it's been largely flat. But Dipan, great to have you on the show. Good chatting with you as always. We'll let you go on that note.